If money is evil, then that building is hell. This is the most obnoxious group of money-hungry, low IQ, high energy, jackrabbit, f***ing wannabe, big-time, small-time, shit-talking, bothersome, irritating bunch of motherfuckers I have ever had to endure for more than 5 minutes.
We see dollar bills, trades, money, prospectuses, things on the street going up, up, up. We see lines going up. If materialism was good, greed is good, and we ought to get greed is good. And see, we can agree on
Why
something.
is greed good?
Greed makes jobs. Money makes the world go round.
Money is the root of all evil.
Money is not the root of all evil.
What's the root of all evil?
Well, we could talk about it later.
Okay.
Greed is good. Greed is good. Greed is good. Greed is good.
Wall Street is a mess. Can I say it any more boldly? Our financial system is a mess because it's all based on trading, heavily based on trading and speculation, and not nearly heavily enough based on investment. We now have some high-frequency traders out there who trade stocks every 15 seconds, but it may even be an average of 15 seconds. It may be trading in nanoseconds. Bam, bam, bam. That's speculation. It's not investing.
The more you bet, the more you lose. And every study that's ever been done says the more you trade, the worse you perform. Because buyers and sellers aren't equal. They're equal to each other, but the man in the middle takes his hunk.
I don't know anybody who has ever been successful in timing the market. I don't even know anybody who knows anybody who has ever been successful in timing the market. The reality is, no matter what the statistics tell you, indexing always wins. I say that because index is delivering the market return, and all those investors out there are by definition getting the market return themselves, less cost. And by the way, if you look at even the last 15 years, counting those last 2 years, the index has outperformed about 75% of all active managers.
There's one more person I would like to introduce to you today, and I'm quite sure he's here. I haven't seen him, but I understood he was coming. I believe that he's made it today, and that is Jack Bogle, who I talked about in the annual report. Jack Bogle has probably done more for the American investor than any man in the country. Jack, could you stand up? There he is. Jack Bogle, many years ago, he wasn't the only one that was talking about an index fund, but it wouldn't have happened without him. The truth is it was not in the interest of the investment industry of Wall Street, because it brought down fees dramatically. Index funds overall have delivered for shareholders a result that has been better than Wall Street professionals as a whole, and part of the reason for that is that they brought down the costs very significantly. So when Jack started, very few people, certainly Wall Street, did not applaud him, and he was the subject of some derision and a lot of attacks. It's Jack's 88th birthday on Monday. So I just say happy birthday, Jack, and thank you on behalf of American investors.
He called you a hero, man. I mean, how do you take that?
Well, I mean, to be called a hero by a hero gives it more credibility than being called a hero by a non-hero. But I don't look. I've already written him a letter this morning of thanks, and I'm not a hero. I'm an ordinary guy, very ordinary guy, who's tried to do my best for investors and who gave a damn about the people that are investing and wanted to make sure they got a fair shake. And if that's heroism, well, so what? So be it.
Yeah.
But it was wonderful to be out there. Investing is about long-term wealth creation. Speculation is a culture of trading with the other person, and we know, Jim, that is a loser's game. It has to be a loser's game, because if you bet A is going to go up, let's say Apple, and you're selling it to someone who believes it's going to go down, one of you are going to be right, one wrong. So the central fact of that trade is the man in the middle, the croupier, the broker, the money manager are all in the middle, and so it's not an even bet. It's a 50-50 bet until the cost of the croupiers is taken out. If it sounds like I'm talking about Las Vegas, I am. We gamble back and forth trying to get other people's money, but the house always wins. It obviously is totally unproductive. We all think that we are on the winning side, but since there are two people on every side, this is what people don't get about investing. It doesn't create value. It subtracts value, where speculation does. And investing adds value.
Welcome back. Our next guest is a legend in the investing world. Jack Bogle founded the Vanguard Group in 1974. He helped turn it into the largest mutual fund company in the world. The Vanguard 500 index that Bogle started and created in 1975 was the first low-cost index mutual fund designed for the average investor. Jack, named by Fortune magazine as one of the 4 giants of the 20th century in the investment industry.
Nobody knows the future. Investors have to understand that anything can happen in the economy and anything can happen in the markets in the course of a year. So it's better to bet in the long term. Cost is everything in this business because when you think about it, where are returns generated for we investors? They're generated by corporate America. They earn money, they pay dividends, they reinvest the remainder in the business, and that's where value is created. The financial markets are the way we access that value. But the financial markets don't give us all of it. They take their share first and then give us what's left, us being we investors. So anytime you can shorten that gap, bridge that gap, minimize that gap, is a good thing for the American investor.
But what about the concept that if we see a market continue to decline, that people will be disappointed in all index funds because they find that the managers are not allowed to sell to get out of the market?
Well, the fact of the matter is that the index fund has traditionally carried about 20% less risk than the average fund. In other words, for all the vaunted ability of mutual fund managers to raise cash, they've really been doing just the opposite. They had 14% in cash at the beginning of this bull market and 4%, only 4% at the peak. They were bearish when they should have been bullish and bullish when they should have been bearish. So the index at least steers a steady course.
Do you still expect, Mr. Bogle, that if this becomes what people call a stock picker's market, that the index funds will continue to outperform the stock pickers?
I don't think there's such a thing as a stock picker's market, Tyler. All investors are picking all stocks, and to the extent an index fund owns all stocks, it's a sort of contradiction in terms, because if the good stock pickers take all the good stocks, the other half of the market will be owned by the bad stock pickers who pick the bad stocks. It all comes out to a sum of one. Yeah, the fees in the mutual fund industry, I'm sorry to say, are generally pretty outrageous. And you add to an average fee of 1.5%, at least another 0.5% for the fund transaction costs inside the portfolio, which isn't disclosed separately. And then mutual funds are tremendously, except for index funds really, tremendously tax inefficient. And the index fund is going to pick up another 1.5 on tax efficiency.
You think they're going to have to come down, though, because of competitive practices and because maybe fund investors will demand it?
I think sooner or later fund investors will see the light. You see more attention paid to cost in the press. You see more dissatisfaction with the mutual fund as an investment medium in the magazines, on television. And I think the industry's got to adjust to a different era. The fees are too high, and that's all there is to that.
You summed up your investment philosophy as buy everything and hold it forever. Do you still subscribe to that in light of what the market has been doing, or would you unload some things now?
No, my theory is not subject to the ups and downs, the peregrinations of the stock, the unpredictable peregrinations of the stock market. It's painful to do, but I think the idea of owning the stock market is the best approach to equity investing, and perhaps I didn't make that thoroughly clear there. I have never felt that equities should be the only portion of an investor's long-term program. I myself am about 50% stocks, 50% bonds, for example. I was brought up when I came into this business in 1951 with the Wellington Fund, which was and is, and I hope always will be, a conservative balanced fund. But I think the idea of buying and holding forever and not trying to make adjustments requires that you've gotten it right in the first place. that you can only hold tight if you've bought right, if you will. And that is to say, have an asset allocation that has something to do with how many years you have to accumulate money, how much resources you have at stake, how much income you need, and how much courage you have to ride out the peregrinations of the market. So you've got to take all that into account from that simple statement. Let me close with 5 simple principles, a few ideas of what you might want to think about, principles of investing that may help you. First, invest you must. The biggest risk is the long-term risk of not putting your money to work at a generous return, not the short-term, but nonetheless real risk of price volatility. Even though stocks seem very high, never think you know more than the market does. You're apt to be wrong if you do. Second, give yourself all the time you can. At the extremes, if you're in the 20s, begin to invest in stocks even if you've only got a little bit. If you're in the 60s, invest more in bonds and less in stocks. But always remember that compound interest is a miracle and time is your friend. Third, have rational expectations about future returns and be mentally prepared for market declines. Always remember, in good times and bad times alike, this too shall pass away, and your emotions can kill you. You should keep them out of your investment program because impulse is your foe. Fourth, rely on simplicity. Simplicity above all. There are too many witch doctors in this business. Basic investing is simple. A sensible asset allocation to stocks, bonds, and reserves, a middle-of-the-road selection of diversified funds, a careful balancing of risks and returns, and lest we forget costs, which can kill long-run returns too. Don't disregard low-cost index funds. That's my only plug. And fifth and last, when you've followed all of these 4 rules, as I said, and I've meant 1,000 times, if not 10,000 times, no matter what happens, stay the course. Good luck in investing in these interesting times. Thank you.